Hello, everyone. Today on the final bar, my guest is Jay Hatfield from Infrastructure Capital Management in New York, talking about more, income-oriented investment options going through year-end into next year. Obviously, a bit of distribution. We're on the highs of the day. A couple of tweets will knock the market down very quickly. So all of a sudden, what looked like a potential breakout out of that 3,200 to 3,400 range, all of a sudden looks like a bunch of bearish engulfing patterns, which speak to short-term weakness. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm Dave Keller, Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at the market activity, the action of markets through the technical perspective, try to make sense of the movements and connect the short-term fluctuations of today with the long-term trends. Really, the goal is to identify trends, to follow those trends, and to anticipate when those trends are reversing. I'm giggling a little bit as I'm sort of giving my regular introduction because days like today are certainly surprises. Although, to be honest with you, now in my 20th year of being a strategist, technical analyst in some form or another, I've seen plenty of catalysts that kind of come in out of nowhere. And the market history is all about how the market anticipates those sorts of unknowns, how it deals with them, and so forth. So, today very quickly was setting up to be a fairly constructive breakout pattern, really getting out of this range that we've been in, with 3,400 really been the upper end of it. When we get to the market recap, we'll talk a little bit more about comments from Jerome Powell and now comments from the president and how the markets reverse so quickly. What does that mean for the long-term technical picture? We'll try to piece that together. Now, we have some fantastic guests coming through the final bar. We're really, really fortunate today to have Jay Hatfield joining us from New York. Tomorrow, on Wednesday, we have Willie Delwich from Robert W. Baird in Milwaukee. On Thursday, J.C. Peretz from All-Star Charts. Then next week, on Tuesday the 13th, we have one of my early mentors, Jeff Weiss, who's a longtime technical analyst, author of Relationship Investing, going to join us. When I think of Jeff, I think of long-term charts and drawing trend lines with a pencil and ruler, and it's incredible how well that keeps you grounded in the long-term trend. So hopefully we get some words of wisdom from Jeff on how he's managing a period of excessive volatility, I would argue. We're going to get to our market recap in a second. I did want to start with a poll. We usually have polls going on the StockCharts TV page and elsewhere where you see our content. I asked you recently, this is a bit more of a quiz. To be honest, it was less of a survey and more of a how much do you know about chart patterns? The question was, what is a bullish divergence? And essentially asked you four combinations of price and RSI. Is price higher or lower? And is RSI higher or lower? Most of you got the correct answer. Unfortunately, there's only 64%. I need more from you, Team Final Bar, in terms of your bullish divergence awareness. You are correct, and a bullish divergence is a lower price and higher RSI. An example I brought out of that is ConocoPhillips COP, which is sort of showing one right now. This is what you would classify as a bullish divergence, where the price is going lower. So we have lower lows in the price from early September to early October, but you can see that the RSI is actually sloping higher. So lower lows in price, higher lows in RSI is called a bullish divergence. And what that generally means is it's more constructive. The concept behind that being prices going lower, prices in a downtrend, and it has been for a little while, obviously. But as prices gotten lower and lower, you first become oversold, which suggests a short-term bounce, which you got. Then this next move down going into this week, you get lower lows in price. We undercut the swing low from September, but the momentum does not go any further down. So it tells you that even though the price is going downward, going lower, the downward momentum, the selling pressure is being alleviated. And so that's actually called a bullish divergence. There are a number of ways sort of outside the scope of the time we have here to think about how to trade those patterns and how to look at how to interpret them. But I'd encourage you to check out our Chart School articles on there. So for the 36% of you that did not get that correctly, brush up on your RSI and price divergences, because there's a lot of message to be seen in the momentum underlying some of these price movements. Having said that, let's get to our market recap. Now, again, things changed very quickly. It felt like the big news of the day was going to be Powell's comments earlier, talking essentially about, potential for, stimulus, the need for it, the economic recovery, et cetera, et cetera. And the market came off a little bit, but really spent the afternoon in an uptrend, and the S&P topped out around 3430. Is really at the highs of the day. And I'm looking at a daily chart of the S&P, and I'm seeing this. We're right at this beautiful purple line I've drawn illustrating the swing highs from early September. We're right up there and actually ticked right above it. And I'm thinking, all right, that might actually be it. We might be breaking out, and I'm ready to sound the bullhorn about S&P 3600. But then this happens, and again, let's keep this all in proper perspective. This is one day, and we still are just below the lows from yesterday. So it's not the end of the world just yet. But what this does tell you is, again, from a purely technical read, we've met resistance. Again, we've come off of it. Again, the tweets were the reason, the catalyst for this coming off. And really the longer idea, the broader perspective is, stimulus not coming until much later. That puts pressure on the next couple months and adds to the uncertainty of the election season with a little less stability than I'm sure many would be comfortable with. Having said that, from a technical perspective, that puts us down within this range of 3,200 to 3,400. It puts us back below just barely the 50-day moving average, which is one of the key parts of our can we remain bullish thesis. So, based on where we close, I think this puts more, in the uncertainty bucket. I mean, the market goes higher from here if people feel the sense of stability and, stimulus, and that things are getting better and that we're not taking steps back. And this certainly is potentially the message from the market selling off after the news this afternoon suggests that this adds to the uncertainty. It doesn't take away from it. So that means volatility increases. That means stocks would most likely go down in the short term. If and when we do continue this retracement, I think based on most charts you're looking at, you see sort of this bearish engulfing pattern, which is a longer down day, an outside day if you follow bar charts where it's a broader range and a down close. Suggest short-term weakness. You're looking at 3,200, and then definitely the swing low from 2 weeks ago as the line in the sand. As long as we remain above that, overall the long-term trend remains positive. And if we would turn the corner tomorrow and go back above that trend line around 3430, again, I'll be ready with the bullhorn to tell you things going higher. I'd love to talk a little bit more about some of the other markets. We're going to talk about fixed income and some other markets a little bit with Jay Hatfield in a little bit, so I don't want to get too deep into that. But let's just focus on the fact that small caps spent most of the day really in the driver's seat, finished essentially flat. Mid caps down about 0.5%. Again, that all came in the last hour. But overall, small caps have been in the driver's seat. We talked yesterday, one of our 3 and 3 charts was the ratio of the IWM, the Russell 2000 small cap ETF versus the SPY. How that ratio has been essentially sideways for a couple months, but starting to resolve to the upside. Today's move and other days like it will continue to push that higher. That ratio is back above its 200-day moving average for the first time in over 2 years. So it's quite a change of perspective. The VIX back up just below 30 with today's pullback. Bonds actually finished a little more positive with the TLT finishing the day up 0.5%. Again, spent most of the day on the downside, and 10-year yields back down a little bit. Gold and silver really got hit and accelerated into the close. So was down going into the 2 o'clock Eastern period, but really accelerated down with silver down the most, around 4%. In terms of sectors, utilities, the only of the 11 S&P sectors, traditionally a fairly defensive sector, but we've seen strength from utilities on up days in the last couple of weeks. So not unreasonable that the market could hold in there okay with utilities and other defensive sectors leading the way. Real estate was number 3 today. On the bottom, you have tech, communication services, and consumer discretionary, sort of the 3 leadership groups going into to the market eye. The things expected to be, certainly have been driving us higher, where a lot of people would be looking for further strength. Certainly feeling some weakness, and a lot of that coming in the end of the day. Let's look very quickly at a couple of charts to round out our market recap. First, I want to look just at the GLD. So gold and silver, as we mentioned, came off. It's interesting that that comes right off of this resistance level we looked at yesterday, the day before. We looked at this chart. This is the Fibonacci retracements using the June low and the August high that lined up really well with the swing lows from mid-August to early September. We tested those levels a lot of times. That was the gap down in mid-September. We then broke lower. Now we've retested that from below. And my comment when we looked at this chart recently was we are now hitting resistance. You'd want to follow through and then a follow through the 50-day. That would really confirm a resumption of this uptrend, but we didn't get it today. And now, just like with stocks, we have a bearish engulfing pattern suggesting some short-term weakness through the remainder of the week. So we'll see if that plays out. But I think that further solidifies some of these resistance levels that we were approaching from below, both with stocks and now with gold as well. Finish off here, I just wanted to look at a couple measures of breadth. You know, this is one of the main breadth charts I've used, and my colors are getting less and less current because we're moving around so much. This is not updated through today. This is updated through yesterday's close, and I changed the colors over the weekend, really looking at the changes in the macro signals from Friday to Friday. So, you know, I color coded a couple of these orange because they're sort of in that intermediate range, and then a couple of these red because they were still sort of negative. What's interesting is the S&P advanced decline line as of yesterday's close made a new swing high. That's going to come off today with everything selling off, but it's worth noting that for one of these metrics, we've actually seen a higher high in breadth. So the S&P is not at new highs, its breadth measure actually is, which speaks to strength under the hood with some of those names. Again, a lot of this breadth picture is going to be fluid given the sell-off that we saw going into the close today. That's our market recap for today. We're going to take a quick break and we'll be back with Jay Hatfield. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. I want to thank you for joining us every weekday after the close for our show. As a reminder, we're going to do another mailbag segment in a little while in today's show. We would love to answer one of your questions in our next mailbag segment at the end of this week. You can get your questions to us via email, thefinalbar@StockCharts.com, or on Twitter @FinalBarSCTV. Of course, if you're looking at our content on YouTube or elsewhere like that, just put a comment right below the video. We'd love to include one of your questions in our next mailbag segment. I want to welcome on our guest today, Jay Hatfield. Jay's the CEO at Infrastructure Capital Management in New York. I grew familiar with Jay's work through some presentations he's made about more income-oriented investments, preferreds, real estate, things like that. I'm very curious to hear Jay's perspective on where we should be looking year-end and beyond. So, Jay, welcome to the show.
Thanks, David, for having me on. I appreciate it.
So we've had this situation. Obviously, you know, I'm sure you're thrilled to come on a day when we have a huge reversal. We came off of highs for the day in stocks and coming off, bonds up a little bit. But overall, you've seen certainly this rotation. If you look at the stock to bond ratio, you know, the S&P certainly is, you know, has been outperforming bonds just in the last couple weeks for sure. We're starting with the chart of the TLT. Get us oriented with your perspective looking at the fixed income markets.
So just to kind of summarize our thesis, we see the Treasury market being the big short of 2021. And I wouldn't emphasize 2021 because obviously the next month or into the end of the year is going to be highly volatile and a lot of different dynamics. But we see three key reasons why Treasuries are a big short, and for that reason also a big risk if you own investment grade fixed income securities. And just real quick, the first is something that people didn't really focus on until this weekend, is the readout of 2 monoclonal antibodies. So that really gives us almost every tool we need to resolve the pandemic, because monoclonal antibodies are, from the data, look like they're effective treatments, rather, not cures, but treatments, and can be used as a vaccine, temporary vaccine. But it's pretty likely that we're going to have readouts on at least one vaccine by the end of the year. So then we'll have all the tools that we need to end the pandemic. Now, it's not going to be like we all rush out into Times Square down the street here from me and kiss each other. It's going to be a slow process where we continue to implement testing, get the vaccine out, get these manufacture the treatments. But if you accept my thesis that the pandemic's going to be resolved, that's critical. So the Fed's going to stop QE. Almost more importantly, the Fed said they're committed to inflation being above 2%. So if that's true, what are the chances of the 10-year being at 0.6? Long bonds respond to inflationary expectations, not what the Fed's doing. So a lot of people are confused the fact the Fed's going to keep short rates low, thinking they're always going to be long-term. And then the final point is that today we really sort of view it as or not really today, but the last week, as the dress rehearsal of how much the long bond could sell off. If you have strong stimulus, which is what the market was expecting until, I guess, 3 o'clock today, then you're going to see pretty substantial sell-off in the long bonds. But we think that's going to be way worse and pretty continuous in the back half of 2021. So that really is the reason that we're cautious and would avoid not just TLT, but also investment grade bonds. And certainly if you hold them, you don't necessarily sell them all, but we would recommend that you rotate into other asset classes.
So that obviously leads into the next logical question, which is if we're not able to treat the bond markets, fixed income markets as a savings account, essentially, where do we go for yield? Where should we be focused?
Yeah, so what you need to be then, so the sensitivity of munis, when I say investment grade, I mean munis, mortgages, total bond funds like Vanguards. So all those are going to be very sensitive to treasuries, from 50 to 75% sensitive to the change in the price of treasury bonds.
Right.
So what you need is asset classes that are sensitive to the stock market, because I think we will have a better stock market in 21, but no sensitivity to treasury. So that means high yield, non-investment grade. We think the best value right now is in what we would call crossover preferreds. So those are preferred stocks that are usually the issuer is rated investment grade, because the preferreds are a couple notches below that, they'll be effectively double Bs or double B pluses. And with those securities, because of the dislocation of the pandemic, you can get yields from 6% to 9%. And those are the type of securities that will not be impacted by treasury sell-off. A lot of them are depressed. In fact, you really can only get these type of securities in the low 20s, which is where they're trading, really kind of once every 10 years. You could do it in 07, 08. You got huge returns by buying them then. So if we're correct about the resolution of the pandemic and an expanding economy and better stock market, then these securities should do extremely well. You can also buy high yield bonds, but they're relatively tight. They haven't been dislocated as much because they're not retail securities. And also the Fed is directly buying high yield bonds. So we recommend investors look to these preferreds that have more of the crossover ratings and will do better in a rising interest rate environment and a better stock market.
So we only have about 30 seconds left, Jay, but I really love this take on things. I would, just one final question for those that are less familiar with preferreds. Do you think of this as a replacement for part of we sort of think of the 60-40 allocation, stocks to bonds? If that's kind of broken, that 40%, is this a way that you reallocate some of that bond allocation, or is this a defensive play within equities as well? How would you think of it from an asset allocation perspective?
I would think of it as a hybrid, just like preferreds are. They sit in between bonds and stocks. So
right.
If you're you can substitute in some of this into a stock portfolio. Just recognize you reduce the beta some. Although right now, given they're depressed, the beta is pretty close to 1, particularly for our funds that we manage. So you can think of those as stock equivalents, at least for the kind of the next 20 or 30% until the underliers get up to their call price. So right now they're trading with a beta of about 1. In a more normal market, the beta would be half. So if you switch from bonds to our fund, then you would be increasing risk. If you switch from equities to some of our funds, you would be decreasing it. But right now, it's sort of a 1-to-1 switch. It's not a bad place to be in markets like this because you're senior to common. So even if you see some volatility, you know your distribution's likely to continue. So there's a margin of safety. They're not, they are volatile securities, and they trade, like I said, like almost like stocks. But in terms of the cash flows, you have some margin for safety because you're senior to common.
This is a great take, and really appreciate you talking us through this angle with weakness in bonds and the potential in the preferred area. Thank you, Jay Hatfield, so much for coming on the show today. We appreciate it.
Thanks, David, for having me on. I appreciate it.
This is Jay Hatfield from Infrastructure Capital Management in New York. And again, my conversations with Jay, it's been a pleasure to talk with him about more income-oriented potential. Reminds me of David Auerbach, who was talking about from the Daily Repeat, who's on the show recently, and talked about real estate and just thinking about REITs and how that fits in. There's an income orientation. I think a lot of investors have sort of mentally written off that certainly could be an interesting time to revisit. Our next segment is the Final Bar Mailbag. This is where we get an opportunity to hear some of your questions and answer them the best we can. Let's get right to it. These are all questions from you, by the way, in the last 24 to 48 hours. Really appreciate you taking the time to share some thoughts with us. Let's see. Question number one. Right after, this is from earlier in the week, right after my previous comment, you showed a chart of PayPal and Apple. Is that an inverted head and shoulder I see on them both? Let's take a look here. So this is Apple. We'll start with Apple. Is that an inverted head and shoulders? I'm assuming you're talking about this, which would be the head down here at the bottom, and then a shoulder and a shoulder. So, is this a head and shoulders pattern? So an inverted head and shoulders. So my answer would be no. And if you go back to like the John Murphy, but the one that really comes to mind is the Edwards and McGee, classic text on technical analysis, in particular chart patterns for stocks. It talks about with head and shoulders patterns. There are a couple of things you really need to have to consider it a head and shoulders pattern. And the first thing is it has to take more time than this. It's not sort of a 1 month or a couple of weeks kind of pattern. This is meant to be like a multi-month sort of evolution. Having said that, I find a lot of times, when we say things like head and shoulders and inverted head and shoulders, a lot of times what we're picking up on is just the general idea of Dow theory, which is, are we moving from a pattern of lower lows to higher lows and from lower highs to higher highs? And if you think of it that way, I would say we've made a lower high most recently. We've not quite made a higher low. I don't think we are done with this sort of move. We haven't really broken out to the point that you can say, all right, we've now established a higher low just yet, especially given the weakness that we saw today. And I think we're going to see a little more choppiness at the very least for the rest of the week. So, until you establish a really good higher low above 105, I don't think you can declare that over just yet. It is a common mistake I found with people declaring a head and shoulders or a change in trend before the current move is even done yet. And I don't think we can say it's really evolved yet, but thanks for that question. Next question. I've seen a couple technicians use both volume and on-balance volume overlaid on top of each other. Could you discuss the use of both of those indicators simultaneously? Man, I'll do my best here. So let's see. I have this chart, which might be the best option. Yeah, so here we're looking at volume and on-balance volume. I'm going to bring up a stock just to sort of give us a different read here. So, essentially what this is the on-balance volume on the bottom. This is the volume read here. So, volume is a whole methodology where you're looking at, the price is most important. For me, volume is always confirmational. What are you seeing a move in price? Great. What does the volume tell you? And, in my opinion, the general trend is in healthy bull phases, you want, heavier volume on the up days. So you can see like this period in June when electronic arts is breaking to new highs, the consistent up days being on heavier volume than the down days during that trend is constructive. Where you should be concerned is if you see the opposite. If you see, a lot of big volume on down days, I don't really see any great examples here necessarily, maybe back here where, as market starts to sell off, a lot of volume going out of there. That tends to speak to more weakness, right? It's heavier volume on the down days. Think of what that means. This is basically saying when the market goes higher, how much volume. And so a big drop in price with a bunch of volume essentially is sellers, right? I mean, that's basically selling pressure. That's a lack of demand, an increase in supply, something that's going to cause the price to go lower. So concerns would be, the price moving one way and then the volume picture doing something different. And that's really the essence of on-balance volume. What on-balance volume does is it takes this and turns it into sort of a cumulative measure. So on an up day, you take that day's volume and you add it to the running total. On a down day, you subtract it from the running total, and you're sort of doing a cumulative volume read. Now, on-balance volume is a very simplistic way to do that. And so I think you would look at that all together as a general volume read. And with on-balance volume, it's really looking at non-confirmation, the price moving higher, on-balance volume not doing that. And again, I don't see any great examples necessarily on here, but a divergence would be really interesting. For me, as you know, I'm not a huge user of volume, and that's just how it's sort of migrated out of my process, given a lot of changes in volume. I used to look at money flow all the time, which is the Laszlo Barini's money flow, but sort of got away from that because I think the volume picture changed so much. Next question, usually I'm able to follow along when you compare two ticker symbols using another platform, but today my IWM versus SPY chart look considerably different than yours, and wanted to know if you could help me. I will not show your vastly inferior charting choice on my screen, but I will tell you the mistake you're making is this. It looked like you were actually doing the difference between the two as opposed to doing the ratio. So when you're doing a performance measure, you're looking at the IWM versus the SPY, you actually need to divide the two symbols. So on our platform, you do IWM:SPY. That automatically does the first ticker divided by the second ticker. You were actually looking at one ticker minus the other ticker, which would just show you an absolute difference in the price. Doesn't make a lot of sense for something like this. It would only make sense if you're looking at like bond yields and you actually literally want to subtract the 10-year yield and the 2-year yield from each other, right? So you're actually looking at the difference between two percentages. But for most stocks or most ratios that I ever show, it's always one divided by the other, and that was the mistake I think you made there. That's all the time we have for questions. I always wish we could get through so much more, but thank you guys all so much for those, and please keep them coming. We'll do another mailbag segment at the end of the week, and we'd love to answer one of your questions on the air. We need to wrap the show though and go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the S&P along with the percent of advancers, decliners. I added this. I usually make the 3 and 3 during the course of the day when I see something that I think is worth sharing with you. I sort of put it on the list. And this I added once the market started to turn south very quickly, because it had been a pretty constructive day with, 3 out of 4, if not more, stocks higher than yesterday. That all changed very quickly. And I just wanted to see where we ended up. It wasn't a huge distribution day, so you can see that a third of stocks still finished higher, 37% by the time I took the snapshot here. It looks about right. So just over a third of stocks still closed higher on the New York Stock Exchange. It wasn't the end of the world type of day, but certainly distribution. This is coming from most stocks up to 2/3 of stocks down on the day. And again, a cluster of 90% down days would certainly be a big negative signal. A cluster of 90% up days would be very much part of an all clear signal from that indicator. Chart number 2 is the TLT. I thought Jay Hatfield's comments about bonds and the TLT bond yields and the benefits of high yielding equity-like securities like preferreds made a ton of sense. And I think the rollover that we saw in the fixed income markets has been pretty key. You saw yesterday, I didn't think to include this on the 3 and 3, but you saw we actually broke down through support. So we've now continued this pattern of lower highs and lower lows for the TLT. Today it bounced a little bit going into the close with the weakness in stocks. And so, we're right essentially at the 200-day moving average. The TLT has been above its 200-day for quite a long period of time. That would be a very different perspective if not, but that's certainly a chart to watch and to see if that weakness in bonds sort of continues. Third chart of the 3 and 3 is Procter & Gamble. And while this particular chart is actually in pretty good shape, I'm highlighting it as an example of looking for stocks that are holding up. In a down tape, when the market closes down, P&G actually closed essentially flat to the open and essentially flat from the close yesterday. It was just up 0.2%, which is sort of a token up day, but overall holding up well above 2 upward sloping moving averages. And when things start to get dicey, focusing in on stocks that are remaining above upward sloping moving averages will keep you in names that are actually holding up when the average stock is breaking down. So while P&G is a decent example of that and could be a compelling idea here, given that it holds above 135, which is that support from the month of September, I think it represents the benefits of screening for stocks at this point, remaining above their 50-day and looking for patterns like this. Those are patterns I wouldn't feel too bad about parking in, given the uncertainty right now around elections. Folks, that is our show for today. I want to thank Jay Hatfield from Infrastructure Capital Management joining us from New York, sharing his thoughts about income orientation. Get your questions to us via email. We'd love to answer questions at the end of the week. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.